Welcome back. This video is brought to you by Forge College. In our last lesson, we tackled using GitHub for issue tracking. Today, we're moving from organizing our project management to organizing computational interactions directly inside the Ethereum virtual machine. We are squarely inside the Ethereum architecture and state changes module. This means we are looking at the exact mechanisms that decide how and when the network updates its shared ledger. If you've spent any time developing on Ethereum, you've likely run into this specific frustration. Take a look at this receipt. You submit a transaction, you watch it fail, and you see all your state changes roll back. And yet, as that orange counter ticks downward, you realize your funds were still deducted. You paid for a total failure. To understand why that happens, we have to look at gas. Gas is often mistaken for a simple transaction fee. In reality, it operates as a strict, continuous accounting unit. It dictates whether your transaction lives, dies, or partially reverts. Mastering gas accounting is the dividing line between developers who blindly burn funds guessing and engineers who build secure, successful smart contract interactions. Let's build a mental model using an airplane flight. First, we have your gas limit. Think of this diagram as your aircraft's fuel gauge. Your gas limit is the reserve, the absolute maximum amount of computational fuel you are willing to commit to a specific transaction. You declare this number upfront. Once the transaction begins, that reserve becomes your runway. The runway is your actively remaining gas. As the EVM executes operations, calculating math, reading data, your runway continuously depletes. But your personal fuel tank isn't the only constraint. The network has a global limit called the block gas limit. Think of this as the air traffic controller dictating the maximum total flights allowed in a single block. Here is the catch. Even if you hold infinite funds in your wallet and set an astronomical gas limit for your reserve, your transaction physically cannot exceed the block gas limit. You are bound by the network's structural capacity. These two layers of limits, your personal reserve and the block's total capacity, are essential enforcement mechanisms. By forcing every single operation to cost a non-zero amount of fuel, the EVM ensures that a poorly written infinite loop will simply run out of gas and halt, rather than freezing the entire blockchain indefinitely. Let's look at how that fuel is consumed chronologically. This timeline shows the life cycle of your transaction. The moment it begins, before a single line of smart contract code even runs, you pay intrinsic gas. This is the fixed upfront fuel deduction required just to package and initiate the transaction. Next comes dynamic gas. This is the ongoing drop-by-drop burn of your remaining runway. Every time your code executes an opcode, expands memory, or writes to a storage slot, a highly specific amount of gas is subtracted from your total. If your code finishes its work while you still have runway left, you reach the commit point. This is a successful landing. Your operation's complete, and the state updates are permanently written to the blockchain. But look at this diagram to see what happens when the math doesn't work out. The orange line traces its execution path until the cost of the very next operation exceeds the remaining runway. Execution instantly hits a wall, an out of gas, or OOG, exception. The transaction crashes. Every single state change made during that specific call frame is immediately reverted, as if they never happened. This brings us to the harsh economic reality of an OOG failure. Why do you still pay? Because the validator nodes still had to expend real-world electricity and computational power to process your code right up until the moment it crashed. You are compensating them for the work they performed. Ultimately, EVM execution is a strict binary outcome. Either you have enough fuel to reach the commit point, or you crash and revert. But in either scenario, you will always pay for the distance you traveled. This gets tricky when you introduce nested calls. This is what happens when the smart contract you are interacting with turns around and executes an internal call to a second, entirely different contract. This diagram illustrates the danger. The inner contract does not get its own fresh fuel supply. Instead, it directly siphons fuel from the outer contract's existing runway. If that inner contract has heavy computation, it can exhaust its allotted portion of the runway and crash. The outer contract now has to absorb that revert, handle the resulting error, and execute its own final operations using whatever tiny sliver of fuel is left. This shared runway dynamic forces developers to write highly defensive, gas-limited code. You have to carefully allocate fuel to nested calls so that your critical outer cleanup operations are never starved of the gas they need to safely finish the transaction. Let's clear up a common misconception about refunds. When you clear a storage slot and free up space on the network, Ethereum gives you a gas refund. But as this ledger shows, refunds are strictly post-execution deferred credits. They are calculated and applied entirely separately, at the very bottom of the receipt. Because refunds are calculated after execution has finished, a pending refund cannot save you. If you hit an out-of-gas error mid-flight, a refund you were expecting later on will not magically refill your tank and prevent the crash. Finally, we need to separate your runway capacity, your gas limit, from your fee incentive, which is the gas price plus base fee plus tip. Paying a higher fee per unit of gas does not give you more runway. It does not allow your code to run longer. The fee you offer purely dictates inclusion priority. It makes your transaction financially attractive to validators, which gets your airplane onto the runway faster than the person who offered a lower fee. Now that you understand the physical fuel requirements of a transaction, you have the foundation needed for our next topic. We'll be looking at how account nonces and transaction ordering decide exactly which flights are cleared for takeoff, and in what order. Always remember the mental model. Your gas limit sets your reserve, operations burn your actively remaining runway, and you must protect enough fuel to reach the commit point. This educational video was brought to you by Forge College. To dive deeper into this subject and explore other Web3 topics, head over to forge.college. Thanks for watching.